Well, good morning, everyone, welcome to our first ever leadership forum here with the Minnesota Mortgage Association. My name is Roger Cadlack, and I'm going to be the moderator for this event this morning. Our topic today is going to be on forbearance. We've got everybody in listen-only mode, but you do have the ability to pop into the chat function and ask questions. The session today is designed to offer information on how to educate our borrowers, our staff, our referral sources on the topic of forbearance. We want to discuss some best practices and just give an opportunity for everybody to share ideas with fellow mortgage professionals. A few housekeeping items before we get started this morning. First of all, I do want to thank our level sponsors of the Minnesota Mortgage Association. Summit Mortgage, Bell Bank, and Fidelity Bank are all level sponsors, and they've been longtime supporters of the Minnesota Mortgage Association, so we thank them for their sponsorship, and without their sponsorship and leadership, events like this are not possible. Like I mentioned before, if you have questions during the presentation, use the chat box, and I will relay those questions to our panelists. I would like to introduce our panelists now. So we've got 4 subject matter experts that have graciously joined to share their knowledge with us. We've got Tony Wyke with Bell Bank. We've got Brian Spenceley, who is Tony Wyke is the president of Bell Bank. He's been with them for 25 years, I believe, or at least in the field for 25 years. Brian Spenceley has been with Wells Fargo for 30 years. He is a senior vice president and loan area administration manager at Wells Fargo Home Mortgage. And we've got Brian Campbell, who is the executive vice president of servicing with Caliber Home Loans. He has over 30 years of industry expertise. And we have Scott Flaherty, CEO of LendSmart Mortgage, based here in the Twin Cities. And he's been in this industry for 22 years. So we have, I think I added up like 107 years worth of knowledge on the panel here. So I'm sure we're going to be able to get our questions answered today. So with that, I am going to open it up, first of all, to, we'll start out with James Campbell on the servicing side of things. And we'd just like to get your comments on why forbearance is, such an issue for servicers and how it has affected, your business and ultimately the lenders and the brokers out there in the industry.
Okay, fair enough. Thanks for the introduction. Why is forbearance such a big issue for servicers? I think when I look at it, the forbearance itself isn't really a challenge. It's the lack of direction that was not forthcoming from the investor community that was really the challenge for the servicers. Both this time with the pandemic and 2 years ago when we had Harvey, Maria, and Irma, there wasn't a playbook that each of the investors had ready to go with natural disasters of that magnitude and with a pandemic like what we've experienced. If the information was ready and available, it would have been easy for us to roll right into the forbearance for the customers, but it took a while for each of the investors to determine what they wanted to do and how they wanted to execute. So it made it very difficult for us as a servicing community to develop a playbook. How has the pandemic impacted servicing at Caliber Home Loans? Well, we staff like every other servicer to a staffing model or to expected capacity, and pre-pandemic, we were around 5% delinquency on our entire portfolio, 1.2% delinquent on our GSE book, a little north of 5% on our Ginnie book, and then wildly delinquent on our privates because we service as a primary or as an exclusive servicer for our parent and owner, Lone Star, that buys NPLs. So we saw our call volume after the CARES Act increase 213%. So you can imagine what that did to our agents, and the impact that it had, unfortunately, on our customers. Our average speed of answer historically had been in the 30 to 40-second range up until the pandemic, and then we saw the average speed of answer go up to 30 to 40 minutes, as some customers were waiting an hour and a half to get a hold of us early on as a result of the pandemic. So we had to institute some very aggressive changes very quickly and to enable our organization to handle the frighteningly high volume and being able to provide quick service to our customers so that they didn't have to wait. So we worked very quickly to integrate into both our IVR, our integrated voice response system, and into our web, a self-help feature for the customers to self-service for forbearance. And since the forbearance is very easy for a customer to obtain, all they have to do is indicate that they've been impacted by COVID-19 and that they have a financial hardship as a result of COVID-19. They don't have to provide any documentation beyond that attestation. It was very easy for us to do both through the IVR and the web. Eventually, we scrapped the IVR and just kept using the web. It allowed us to ask a few more questions so that we'd be better positioned when the customer came off of the forbearance to ask them some color on where they were at based on the answers they gave at the outset of the forbearance. So today, the environment, we're pretty much back to normal with our call centers. We increased our staffing 100% in all of our call centers. We made quick adjustments within days after the impact of COVID-19. We opened up our recruiting, and we've doubled our capacity at every single one of the call centers inside of collections, customer service, and our single point of contact teams. So now, as of yesterday, I was inside of 30 seconds average speed to answer, and our customers can get a hold of us as they need to, so that we basically responded quickly and efficiently, although it was unfortunate for about a 10 to 2 week period there. We just had real struggles handling the call volume and serving our customers.
Yeah, the ramp up time that everybody had in the industry, whether from a servicing standpoint or origination standpoint, underwriting standpoint, was amazing to get people working out of their homes in addition to just dealing with all the changes going on in the industry. So, Brian, being with Wells Fargo, one of the if not the largest servicer of mortgages in the country, I can imagine you guys had some pretty significant challenges as well. Can you speak to some of those and how it has affected your side of the books?
Absolutely. Good morning, and thanks for having me. So, like James, we experienced quite a few challenges early on. So let me just kind of talk about, maybe in a non-statistical way, but talk about really where we found our urgency to be. And if you think about servicing, there are 7 different investors out there that have unique requirements. So like James mentioned, there wasn't a playbook. So there was a tremendous collaborative effort working with Fannie, Freddie, FHA, VA, USDA, our private investors, of course, our own book of business within Wells Owned, and trying to really collaborate on a consistent approach so that we could streamline our either outbound or inbound efforts in communication with our customers. So if you think about that, there's a lot of policies, unique expectations, and then let's think about the overlay of the regulators on top of that, and as James mentioned, the CARES Act. So just trying to put that all together quickly in March in response to the pandemic was a huge challenge for us. Now, the good news of that is, and like James mentioned earlier, we have experience with this, right? We dealt with multiple natural disasters. I had the experience of working in the servicing sector back during the housing crisis when we developed programs to help customers stay in their houses then. And of course, the HAMP programs were brought on by the government. So we kind of had a good view into how to operate and what to expect, but this was different. This is unique. This hits every state and thousands and thousands of customers. So it was really all about trying to collaborate with our policymakers and all of our investors in order to achieve a consistent approach. I would probably tell you that, one of the largest challenges is really about communication. That's the key piece for us. It's being able to meet the needs of our customers in the way they want us to. And so with a little bit of uncertainty with the pandemic and how long it would last, we chose a certain approach and allow all customers in, whether they're current or they're delinquent. And so that made it easier for us to bring them in. And I would probably say what really defined us during this time frame was automation, was our ability to quickly and effectively add to our web page that access for customers to self-serve and to be able to tell us that they're impacted, again, without having to prove it, but just purely just telling us that they're impacted, they opt in, and then we're able to service those folks appropriately. Another key piece of automation for us in this environment, and James mentioned this very well, is capacity. There's only so many team members that you have that are available to service something of this magnitude. And of course, we quickly recognized that we would need to add staff. We put out recs. We worked with vendors, third parties. We mobilized internal team members who weren't as impacted with COVID and moved them into roles that could help support these customers by phone calls. In fact, an example of that is I have 270 underwriters who basically we stopped underwriting files because we were providing this forbearance, which is 3 months of suspended payment. So we were able to navigate and train 270 underwriters who really understand the credit side very well. And some have good backgrounds in communication. They may have been promoted from a single point of contact to an underwriter in the past. So we put them back on the phones to help service these needs. So we're pretty excited about the fact that we're versatile and flexible during this environment. It needed to be so. But no doubt it was a challenge in doing this and doing it on the fly as customers were continuing to opt in. So I would probably wrap up by saying, if you just look at it from a very macro level, the ability to manage multiple investors' policies, to gain agreement and alignment on how to approach them, how to approach our customers, provide them confidence that we have plans, we've got programs, we understand the dynamics of impacts to their credit, impacts to suppressing late fees and foreclosure activity and so on. And to be able to build automation on the fly to continue to serve those customers post forbearance has been really significant for us. I'd wrap up by saying the economics as a whole is challenging. If you think about any servicer for that matter, there's a large sum of payments that we are forbearing and moving to, possibly to the back of a customer's loan. So we've got to care for our investors and our shareholders and our customers in a balanced way. And that makes it challenging. But certainly, again, with the experience we've had in the past dealing with natural disasters, we've been able to do so thus far. And I will tell you that the next 90 days or the next 6 months or the, maybe not really knowing for sure when a customer may come back or may want to come off their forbearance is really the next challenge that we've been managing to and preparing for. So we feel confident that we've got the right answers from our investors. They provided us with the policy, if you will, what we need to do. And we have acted on creating really a self-serving scenario where they can come back to us and tell us they're either ready to make payments, they need another extension, or if they were delinquent pre-COVID, that they need another modification or some other loan home preservation program. So quite a bit at stake here, obviously, for all of us and all of our customers. And it's been challenging thus far. So.
All right. Thank you, Brian. That is a lot of moving parts there for a company and organization of your size. I want to shift it over to Scott and Tony here, just to talk more on the origination side of things. So I'll start out with Tony. If you can kind of just give us a little overview or talk to the magnitude of this topic, how it's affected, your organization when it comes to originations, and how you communicate with your loan officers, and how your loan officers communicate with your borrowers, and what type of changes have you seen in your organization?
Thanks, Roger, and thanks everyone for having me here today. Yeah, it's as Brian and James both said, there wasn't a playbook, and so as we were dealing with the ever-evolving guidelines and updates, with Bell, we have a servicing portfolio, and obviously we're origination as well, and so I have the pleasure of being on both sides of that and trying to manage the guidelines on the updates and continuing to stay in front of it. That really was the biggest challenge. It was getting clear and concise information from the very beginning, at the CARES Act being released, then to what it really meant and how it was being implemented. And you continue to see that evolving of guidelines. From the origination standpoint, if we would have had this call a month ago, I think, or even 3 weeks ago, I think the frustration would have been significantly higher than it is today due to some of the new guidance that has come out, specifically from the GSEs and what it means to a borrower and their ability to qualify in the future. Recently, with that direction, we've been able to better educate. So we've taken a lot of time and focus of first being able to get the guidelines, digest them, ask the questions, figure out what it really means and how to implement systems. But it started with educating our staff, educating our sales staff, educating our underwriting staff, educating our servicing staff to deal with that. From that standpoint, it then became, to the best of our ability, taking the knowledge that we were able to obtain and then getting it into the hands of the people that can help our clients. And it started with our servicing side. As Brian and James mentioned, it was hard to answer the phones, but having a focus or building automation as we could, but still have as much education involved as possible, because forbearance at the end of the day isn't, it's not a free ticket, and you still have to make the payments eventually at some fashion. And so that soon evolved in how do we educate, instead of dealing with our servicing portfolio, to our clients, someone who just signed up for forbearance. The qualification standards, which I think we'll even talk about a little bit more later, but it was pretty wide, pretty easy to qualify. If you're impacted in some fashion, per the CARES Act, you've qualified. Now, the secondary thought, which wasn't, I don't believe, really thought out at the very beginning, was, well, what about the loans that aren't being serviced, all the people that want to refinance right away, all the people that are kind of impacted, but not significantly impacted? What does it mean for them? At the beginning, there wasn't repercussions identified, which has then filtered out over the months since the CARES Act originally came out. So I can say, in terms of how it's impacted, it is just dealing with the onslaught of guidelines, updates, misinformation in the marketplace, or misunderstandings in the marketplace. I think is also has been a significant issue, because a lot of people, we all watch the same news channels, and depending on the speaker or the time of day or what channel you're on, you will get different opinions or different directions, which then that's who our clients, that's what they have to rely on until they were able to speak to a mortgage professional in some fashion to be able to get educated. So the biggest impact, honestly, has been just staying on top of it and getting our staff educated in a very fluid situation over the past 3 months, to be able to appropriately educate clients on what are the choices that they have to make, what is their best choice, or give them education so they can make the best choice, has really been the biggest impact, I'd say.
Thank you, Tony. Thank you, Scott. I want to flip it over to you, and kind of same question. you've got multiple investors that you work with and you sell your loans to at your organization. How have you managed through, that dynamic with your loan officers and down to your borrowers?
Yeah, thanks, Roger, for having me part of this, and thanks for letting me bat cleanup, because everybody else has said all the intelligent things, and I can just kind of regurgitate what they've said. So I'll focus a little bit on, I guess, the originator side of things. I do think all of our companies have had a significant impact operationally, having to deal with the things that everybody else has said. But that, means something different to the origination staff, and it's been a challenge for them, because as these operational changes have happened, as we've had to deal with them, right, because of what the investors are doing, because of forbearance, because of the disclosures that are needed, and everything from final verbal VOEs within 3 days of closing. These all impact Street, and so we've kind of focused on how are we going to educate our originators through this, right? And that's been, I guess, the really the biggest impact, I think, on us is dealing with all of the changes that come down from our investors. And ultimately, what does that mean to the borrower? What does it mean to the originator, who has to now explain this forbearance disclosure document that we require the borrowers to sign? They have to be able to be educated on the origination side as to why there's now so much pain for the borrower in this transaction, right? And the reason there's pain is ultimately because of the forbearance concerns, right? That was the driver of everything. When you didn't know if 20% of people were going to be in forbearance or 10% of people in forbearance, and what does it impact to the industry? Well, that gets down to the street level and makes pain for the originator and makes pain for the borrower, because everybody's trying to change something on an operations side to protect themselves. Well, that impacts the street certainly significantly. So we've spent a lot of time trying to educate our origination staff or processing staff as to a little bit about why this is happening, because in order for them to still execute a smooth transaction with their client, they need to be able to explain why they're being asked for so much more, or have different disclosures, or have a few more pain points, I guess, in the process than normally would be. It's ultimately, I think, as a result of the forbearance fears and what that means long term for ultimately foreclosures and predicting where that's going to go. So that's been certainly a large impact, I think, for us, is just dealing with that education and dealing with being able to still close loans operationally in the smoothest way possible, given all the changes that have been made from every investor looking at this a little bit differently or having a different policy.
All right. Thank you. Thanks all four of you for your opening comments, kind of laying the groundwork. I invite everyone to, if you've got questions for the panelists, just type it in the chat box. If you wanted to go to a specific panelist, just put that in your commentary, and I'll pass those questions along to them to kind of get things started. We've got some questions that were sent in ahead of time, so I'll kind of kick out a couple of those. But I had one that just kind of popped up to me when Brian was talking regarding the Congress and what's required and so forth with the CARES Act. Just curious, Brian, from your perspective, you must kind of have the inside track on some of this information. Do you expect Congress or the FHFA to put into place some qualification rules around the forbearance? A lot of the conversation has been, hey, there's been no, you need no proof to request a forbearance. And you get anecdotal stories of folks taking advantage of the system and requesting a forbearance when it wasn't necessarily, related to COVID. Have you heard anything around that, and can you speak to that at all?
It's a great question. It's that question surfaces quite a bit out of the courtrooms today, specifically in New York. Because they continue to look back in terms of what they learned during the HAMP days. But I have not personally been involved in any dialogue there. I would tell you that what I thought was very positive about the CARES Act was the ability to simplify the approach, because, I think we can all look at this and go, what's this? What was this? What's this mean to us? It's not regionalized. It's not a specific disaster that impacts a home that needs repairs or a business that can't be in business and people are laid off, and that's probably over a set period of time where they'll get back to work because the business was repaired or the flooding has gone away and so on. So I do like the idea that the CARES Act made it simple. Now that made it tougher for us, but we also chose to make this an easier opt-in, if you will, knowing that all customers are impacted either directly or indirectly. And when you think about traditional hardships, where customers are asked to show or prove their hardship with income documentation, they fill out a hardship affidavit. We can't get into a conversation or dialogue around a health issue. It's not appropriate, not allowed. So you need to keep this as simple as possible and hope that we do a fantastic job of communicating what the forbearance means, when it can end, how long it's out there for, and let customers make the informed decision on how long they need that help. So I don't anticipate, Roger, that we're going to have additional legislation around this. And the only caveat might be, will there be another outbreak? Will there be, what else do we not know it's going to happen that might motivate legislation around this? But I don't personally foresee any other eligibility criteria being provided here. I think it's up to us as servicers and policymakers to pay real close attention to the marketplace and continue to influence where we think it's appropriate to simplify this and help our customers sustain home ownership and to take care of their families and their health.
Okay. Thank you. Well, I still don't see any questions in the chat box, so people don't be shy here. I'm going to throw out a question to James Campbell that came in ahead of time. So James, are there any financial or credit-related penalties for requesting a forbearance?
There are no financial penalties for requesting a forbearance, but I do want to point out that with the GSEs, they have a deferral, and the challenge for the customer is that when they come off of a forbearance and they get a deferral, the only thing being deferred is principal and interest and any advances that the servicer has made on behalf of the customer. So unlike an FHA loan where we have a partial claim capability, and let me explain the difference between the partial claim and the deferral for the audience. The partial claim allows the servicer to take the entire payment, the 3, 6, 9, or 12 months of payments that were missed as a result of the forbearance, and put those into a second lien that is owned by HUD. And so what we would do is we would defer both the principal, interest, tax, and insurance portions of the payment and put those into a second lien that bears no interest and requires no payments and is due and payable at the maturity of the first lien. So basically, it works as if the customer has been making their payment for the duration of the time that they were on a forbearance. So when they get off the forbearance, they resume making their normal payments. They have a escrow analysis, and the escrow analysis wouldn't be impacted because they would have got consideration for the tax and insurance portion because all of that would have been included and deferred to the end of the loan. The difference with the GSEs is sizable. So, and this is the piece on all the housing policy calls that we have every week that I've kept raising my hand on over the last 2 months and saying the deferral is a great way to avoid having to pay any of those amounts due at the end of the forbearance period. But the challenge is it's deferring only the advances that the servicer pays to cover a borrower's shortage during the forbearance period. So let's just look at the way that you normally handle payments for a mortgage loan. The customer is making their if they're escrowed, they're making their tax and insurance portion of the payment as well as principal and interest. And that tax and insurance goes into an escrow account that then is used to pay the taxes and insurance that are due during that 12-month period. The way that the deferral process works is it defers only the P&I payments that were made, and then any actual taxes and any actual insurance that was paid over and above the amount that is in the customer's escrow account at the time that we had to make those payments. So if there's sufficient funds in the escrow account when we have to make those disbursements, then all we're going to be able to defer is principal and interest. So when we resume having those customers make their regular payment, they're going to have a shortage in their escrow account because they haven't been paying in to that T&I portion of the escrow account throughout the 3, 6, 9, or 12-month period of the forbearance. So they will see an increase regardless of when they end their forbearance. They're going to see an increase in their tax and insurance payments when the escrow analysis occurs after the forbearance is completed. Some servicers will do that escrow analysis right when the forbearance is completed, and it'll show that the customer owes additional funds. So Caliber historically has been more lenient than most servicers. Most servicers will only spread that shortage over 12 months. Caliber will spread it up to 60 months, but that still could potentially create a hardship for a customer. So some customers, the right thing the servicer is going to have to do is analyze before they put that customer into a deferral, the customer's ability to make the adjusted principal, interest, tax, and insurance payment post forbearance, because the option that the customer may need is a flex mod that gives them more payment relief than a deferral. So while there aren't any fees for the customer for the forbearance, there is a risk because the way that the GSEs have structured the deferral, they're only deferring actual advances that the servicer makes and not the T&I portion of that payment that was due to the end of the loan. Is that clear?
Yeah, that's a lot of stuff there that borrowers are going to, I think that you're just kind of, just the tip of the iceberg of what we're going to be seeing here in the next few months as borrowers start to come out of their forbearances, start to set up their payments, and I think there might be a lot of awakening going on as to what those new payment structures are going to look like and how they're going to look.
Yeah, Roger, it goes back to what Brian said in his opening remarks. It's all about communication and education of the consumer. And so we've been making a point to make certain that we educate the consumer throughout the forbearance period, especially those GSE consumers, because they're not going to have the same benefit that an FHA consumer will have when they roll off of the forbearance and go through the partial claim.
Okay, yep. And that's a good segue. I'll push this next question over to Tony. If you want to share with the group, let's say you've got that borrower who is just coming out of a forbearance. Can you explain to the group, what the rules are around about, let's say he wants to refinance his current loan, and he just came out of a forbearance. What the question that came in order to get a new loan, what will they need to provide their new lender as far as proof that they canceled the forbearance request or have made timely payments?
Thank you. And so great question, and seeing that a lot these days as clients and are trying to take advantage of the historically low rates, both purchase and refinance. Really, at the end of the day, they're not there's some variability, and I'll let maybe Brian and James can follow up after this. But as far as we understand, there is not a formal form that has to be done in every situation. Say my forbearance is over. And instead of that, from a qualifications standpoint, guidance has been more of making sure they're either current on their payments and have not ultimately missed a payment. So a scenario where borrower went into forbearance and they skipped one payment, which we've seen a lot of consumers and dealt with a lot of consumers over the past 60 days. They were impacted, but they still qualify for a loan. Maybe they lost their overtime, something of that fashion, or their spouse, but they still qualify on a single borrower's income. They still qualify for the loan, but they took advantage, or they took advantage of the forbearance program. By making that missed payment, they're immediately current. There is no further additional information we need to get from their current servicer, as far as we interpret it, to say I'm done with it. It's more, are you current on your transaction? That's the one bucket people fall in. The secondary bucket is where they do go into and they skip, let's say, 3 payments, and they take advantage of the deferral option, and they move those payments to the end of the term of their loan. In that situation, if there's any deferment or loss mitigation type of a structure in the repayments, it comes down, then the qualifying is making sure we can document 3 of their new payments, whatever that amount might be. If they deferred, outside of having a escrow reanalysis done and their payment being adjusted, it would be going back to what their old payment was, and they just missed 2 or 3 or 5 or whatever the number. In situation where they go into a loss mitigation effort, as James talked about a minute ago, sometimes there's different options, and repaying over an extended period of time. Then it's making whatever that new payment is, and that being current on 3 payments, would then make them eligible again for financing at that point.
Okay. Anybody want to add to that, or does anybody have any additional comments on that question?
The only comment that I would have is that it really depends on how the servicer is reporting to the credit bureaus. If they're following the reporting that's required in the CARES Act, if a customer comes into a forbearance as a current customer and they request a forbearance, there's 2 different ways that they can be reported. If they aren't making payments during the forbearance, they're going to be reported as contractually current, but they won't have payment history reported. So when a originator goes to pull their credit, they're not going to have a history. Conversely, if the customer is making they request a forbearance, but they make payments throughout that entire forbearance period, not only are they going to be reflected as current, but they'll show a history that showed that they paid their payments on time for the full 3, 6, 9, or 12 months.
Okay, thanks for that. Actually, that was one of the questions that was next queued up. How does it report to the credit bureau? And maybe Brian, you can speak to this. The question was specifically, will the balance show an increase on the credit bureau when it's in forbearance?
Yeah, the answer is no. It will not show an increase on the credit bureau. And what we do is we do place a message, which is the forbearance message, on the credit bureau, but it does not increase the amount that would reflect on the credit bureau. I would add one other thing just to the conversation. This was a very popular topic early on, and just for perspective, of course, I get the chance to work with both the retail side of Wells Fargo originations and, of course, servicing. So we had a lot of examples come up early on where customers were looking at this as, which way do I go? Do I really need this forbearance? Like, what does it mean? And that made that communication of what it means all the more important. It was a quick learning curve for us to think about that, and we identified the customers that were in, I'll call, both channels. One was trying to refinance, at the same time they were thinking about opting in for the forbearance. So we needed to quickly reach out to our retail partners, explain what we were doing and how we were doing it, and collaborate on talking points for both sides. That wasn't easy, by the way, because of the evolving nature of the policies in place. So, but generally speaking, customers need to be current. If they opt in for the forbearance and miss 2 payments, or maybe they're continuing to pay, because they can continue to pay us during the forbearance period. But if, at the end of the day, if they want to refinance, they're going to need to prove their ability to repay. And being current is going to be a key piece in the underwriting channel. So we encouraged our customers through talking points. We put the Q&A, all the questions and answers on our webpage. If you're considering one over the other, here is what you need to decide. And of course, to work with an expert in the retail channel as much as you're working with an expert or a single point of contact in the servicing channel. So pretty large topic for probably everybody in this industry during this time frame. And you know, hopefully we've provided the right communication for folks to make the right decisions.
Kind of follow-up question to that for you. Let's say you got a situation where a borrower requests the forbearance, but they've been able to continue to make their payments for whatever reasons, whether they pulled it from savings, and they've continued to make their payment, and now they want to buy a new house. So credit report gets pulled, forbearance shows up on their payments have been made as agreed. From an underwriting perspective, is there concern that, hey, this borrower has self-declared a hardship? Do we have issues with lending to a borrower who has declared a hardship? Does that come into play from an underwriting standpoint? And I'll open that up to any one of the panelists. Scott, what do you tell your folks when you get that question, or haven't you?
Oh, yeah, we've seen it, you know, often, right? So I'd be, you know, curious as to Brian's reaction on how they're handling that. But certainly it's posed problems for us to this point, and there is concern with that. And of course, we're applying now the guidance that's come out recently on what Tony was talking about, needing to be current in order to be able to complete that new transaction. It may be a conservative route, but I'm curious as to how Brian's company is handling that.
Yeah, here's what I would say, and just to be transparent, I don't work on the retail side, but I obviously partner with them when they have questions. I'm kind of their conduit amongst other duties. But the questions that have come in either to our customer service group, in some cases it's just an inquiry that goes to our complaints team. It's those questions, and I think I think it's safe to say, you know, very high percentage of customers opted in for a forbearance early on as a form of, I would say, insurance, just not knowing for sure what's going to happen to them. And again, you know, very early on in March, thinking, well, I better take it just in case, and maybe it's not available later on. So, but a lot of cases, those customers didn't miss employment, they didn't miss income, so they took it kind of as an insurance policy. And as we educated them on what this means, and if they were thinking about taking advantage of a low interest rate environment, we made it clear to them they must pay. And our retail folks made the same point to us, that in order to refinance or to purchase, you need to have those payments made current, not through moving those delinquencies or moving those payments, I shouldn't say delinquencies, moving those suspended payments to the back of the loan. So the underwriting criteria for Wells has been, you need to prove your ability to repay. If you have a hardship, that obviously brings a question, and can you underwrite to those standards? And most likely to deliver a new loan, it can't have a hardship. So that's been the perspective of Wells at this point, underneath at least my knowledge and the experience I've had working with individual customers. And we are spending a lot of time, again, educating the retail side, so they're able to also, you know, direct customers or inform them so they make an informed choice. The bottom line is, if customers were current and they chose the forbearance but also want to refinance or purchase, they need to keep their loan current. That's what's going to help them qualify and obtain new financing.
Thank you. As a reminder, we got 50 people on this call. I still don't see anybody queuing into the chat, so I'd love to hear, some organic questions come up as you hear the comments from our panelists here. I'm going to move to a topic here, kind of throw this out to maybe to Scott, because early on this was well, it probably still is an issue, but Fannie and Freddie, I think, imposed 500 to 700 basis point hits on loans that were entered into forbearance as soon as they closed. Obviously, that's a pretty steep haircut for folks like yourself. What, if anything, do you do, or how do you coach your loan officers and borrowers around the forbearance and what it means? I know it's obviously a touchy subject, because if they need the forbearance, they have the right to get it or request it. But have you run into situations where a borrower closed a loan and right away requested a forbearance before the loan's even sold to Fannie or Freddie? Do you have guidance to your loan officers around that? Can you just kind of speak to that and how your company has handled that issue?
Yeah, certainly. So we have been fortunate enough not to have that situation happen, and I think that's been rare from our partners that we've talked to. It's why you've seen people like PennyMac and AmeriHome remove their guideline that said that we have to pay as an originator selling ultimately to them in the secondary market, that we would have to pay that 5 to 7% hit if the what they had was a 2 to 3 week time frame to securitize that loan. That if the forbearance happened in that period, they're going to push that back to us. Well, that's been removed now. I think mainly because, as I talked to them, it's been rare for them to see that happen that quickly. But it doesn't mean the education doesn't still happen. We have a disclosure form that goes out initially and at closing that talks about forbearance. So we try to educate our originators to bring that conversation up as early as possible, because, of course, I want to explain to my borrower what they're signing, right? And this is a new document that talks about what is forbearance and what does that mean to you. And ours even talks about the fact that, we'll be your lender, but, right or wrong, James and Brian may raise an eyebrow, maybe it's the language in ours, but ours tells them that they're not eligible for forbearance from us, because our attorney's opinion has been that it's not a government loan until it reaches the security. And so we're telling our borrowers in our disclosure form that, forbearance, you've heard a lot about it, and it may be an opportunity for you, but while we hold your loan, it's not something that we're even going to accept as an opportunity. We're not going to grant forbearance because we don't have the ability to do so. So we've had a lot of conversations and trainings with our origination staff about how to explain that document. And I think it's a good thing to bring that up. I know a lot of our top originators, that's just part of the process. They open up the forbearance conversation early to educate their borrower, because as James is talking about, it's not a free pass for everybody, right? It's not hey, I get my payments off and I don't have to worry about it anymore. There are potential impacts and consequences when you come out of forbearance. And what does that mean? And what does that mean to my credit if I have to go into a modification agreement, right? And how is that going to impact me as a borrower if I want to go get a car or take advantage of a refinance? So we encourage our loan officers to educate their borrowers up front, discuss this document that we have, and discuss what the impacts are for the customer after forbearance is done, and are they going to have the ability to just write that check potentially for the amount that they've missed, at least on the taxes insurance side. So that's how we're handling it from a training standpoint.
Okay, thank you. I just got an email here. Apparently, questions are coming in under the questions tab, which apparently I don't have access to. So somebody just sent me a few questions. So I'm going to read off a few questions that have come in from our listeners. This one's from Keenan Raverty, and it's to James. He said, he asked a question. He had indicated, James, that's you, James had indicated some of his servicing was wildly delinquent. What does that mean by the way up percentage, and what is being done to correct it?
So the reason they're wildly delinquent is because our parent buys them from organizations like Chase, Wells, and Bank of America when they're trying to offload non-performing loans. And so the average days delinquent of the NPLs that our parent is buying is roughly 800 days. So my job in servicing of those loans is to get those from an NPL status to an RPL, or a reperforming loan status. So we use a suite of modifications that were designed specifically for those private loans. So these would be loans that were at one point in time a Fannie Mae, Freddie Mac, FHA, VA, or USDA loan that have either come through the DAS program and been bought out of the HUD pools, or they've been purchased out of Fannie or Freddie, and they're now private loans through Fannie or Freddie whole loan sale or they could have been loans that were on a bank or a non-bank's portfolio, and they've sold those off. So we work on best execution. We've bought over $60 billion worth of NPLs in the last 12 years. And so the reason I say they're wildly delinquent is because they come to me 3 to 4 years seasoned in delinquency. And what we do is we work very aggressively to get them into a RPL status, where then they get sold by our parent as a reperforming loan, generally to investment banks who partition those out and sell them to their clients. So that's why I said wildly delinquent, because they are in fact wildly delinquent when I get them.
Okay. One more follow-up for you too, James. Sarah Johans had a follow-up question regarding your comments on the escrow shortage that the borrower will realize will not be reported as late or negative on the credit bureau. Is that correct?
That's correct. That's correct. The escrow portion of the payment has no impact on credit bureau reporting, but what it is going to do is it's going to impact the customer's affordability to make that payment going forward. And that's why, as an organization specifically centered around our history with non-performing loans, we've spread escrow shortages out to 60 months to try to be as forgiving with the customer, to try to put them in a situation where we could give them an affordable payment. Even spreading it out to 60 months, if somebody goes out to 12 months on a forbearance, they're going to have a massive shortage. In places like Texas, where I live and work, or where I used to live and work up in New Jersey when I worked at Credit Suisse and Deutsche Bank, the taxes in both of those states are atrociously high. And so a good chunk of your mortgage payment, oftentimes 50% of it, goes to just pay taxes and insurance. So you can imagine having your payment go up by the equivalent of your taxes and insurance amount for one payment to a factor of 2. So basically, your payment could go up to 150% of where it is now if you had to catch up 2 years of tax and insurance payments in 1 year.
Okay.
Thank you. James, Roger, you mind if I follow up with James on that for a second?
Yep.
So this is James assuming that, from what I'm understanding from you, that the payments that they miss are not part of that. It's only tax and insurance. Is that an automatic for your company right now, or is there the script that's being followed where step one is you missed 3 payments. Let's make all those 3 payments right now back to us at Caliber. Step 2 is, okay, we'll do them over 12 months. And I'm talking about the principal and interest as well, right? So is there a succession there of options for the borrower, or are you guys automatically defaulting towards, all right, you missed 3 payments. If we can, we'll just throw that on the end of the loan, and the only thing we're going to recover is tax insurance.
We actually go through the waterfall based on the investor. So if it's a Fannie Mae or Freddie Mac loan, the first step is to see if the customer can reinstate. And that really is the case with any investor. The first step is always to see if the customer can reinstate. So when we've all heard over the last 3 months that those forbearance payments are due and payable at the end of the forbearance period, that's correct. But there are other options. So if the customer can't pay those 3 months of payments, then the next step with Fannie and Freddie would be to see if the customer can engage in a short-term repayment plan to pay those back. If they couldn't do that, then the first true loss mitigation option for the customer is a deferral. Now, if the deferral proves to be not cost effective because they can pay their regular mortgage payment, but because of the impact of the increase of the tax and insurance to their total mortgage payment on a monthly basis, they could skip over the deferral and we could give them a flex mod. And the flex mod was rolled out by the GSEs a couple years ago to replace their HAMP mod to provide the customer with payment relief. So the idea of the flex mod is to provide about 20% payment relief off the principal and interest portion of the payment. So you could see some relief that would offset the increase of the T&I portion by going to a flex mod if the deferral didn't work for the consumer. So yes, there are options, Scott.
But I would have to assume that those options then would potentially negatively affect the client's credit if they were in that modification.
So yeah, mod can potentially have a negative impact on a customer's credit. That's correct, because it's going to show up that their loan was modified.
Yeah, not just to my. That's what we're trying to educate our clients so that I don't think that they realize that the best option for them is always to pay the payment if they can pay the payment right now, because if they get into this situation where they're missing 6 payments and they have to go into this modification program, that could be a long-term detrimental effect to them as it relates to their credit.
It could, but most of the options aren't mods. So the deferral is not a modification and it wouldn't impact the customer's credit in any way, shape, fashion, or form. All it does is take those missed payments and tack them on to the end of the loan. So it's going to impact the total debt of the consumer, but it doesn't modify the terms. So there's no requirement by the GSEs to get a signed agreement from the customer and record that. That's really an option that they give to the servicer. And then on the FHA side, you're just getting a second lien. So that could potentially affect your credit because you've got additional debt, right? But other than that, there's no modification that shows up, so you wouldn't have any negative reporting other than the fact that you have additional debt.
Thank you. We've got a question here that's kind of along these same lines that you guys have been talking about. So I'm going to throw this one over to Brian. It's from Julie Guggen. Is there data that you can share about what the likely post-forbearance environment will look like? What percentage of consumers will take which options? Have you got anything you can speak to on that?
That is a great question. I can tell you this. We spent at least 2 or 3 weeks trying to forecast that, and I feel sorry for some of the risk analytic people and folks that work in the forecasting space. I will tell you there's a probably daily effort to understand by delinquency who's opted in for the forbearance. So it's maybe a little easier to predict where a current customer might go versus what I'll call pre-COVID delinquent customer. Pre-COVID delinquent customer was somebody that was late prior to the pandemic and the policy that were put into place, right? So more than likely, those customers are going to come back into us needing supply, additional information, income documentation, etc. And we'll proceed, like James mentioned, through the waterfall of opportunities by each investor. But for those that are current, we're going to face some unique things. For example, how many current customers pre-COVID are underemployed right now? Not unemployed, underemployed. Meaning they might be back to work, but maybe not at 40 hours per week plus the overtime they were getting. So if that borrower wants to continue with another 90 days, that's great. They can do that, or we expect that. And so if they want to resume making payments or converse with us on, well, what else? I don't think I'm going to get more income from my job. Then I want to see what other loan programs or modification programs you have. So those customers now turn to us, and we need to, again, run through the waterfall to figure out what else is available for that customer. And my point is this. It's very unpredictable, which is why James and I, many other servicers, are ramping up staff and capacity. And if you think about the economy, if you think about all the conversations in the news around another recession, for example, we're just seeing some market indicators in the last couple of days. It leads us to believe we're going to see a spike in delinquency at some point. It's just hard to predict when. So the initial stats are telling us that 30% of our customers who opted in for a forbearance in March would like to speak to us again. And we've enabled that. We want that, okay? I would tell you another 40% have said to us, we'd love to extend another 3 months. And by the way, I want to caveat this. This is after 4 days of communication with customers. And we're tracking it every single day. How many want to speak to us again? How many want to extend? How many are ready to resume? The good news is that a very high percentage of current customers are wanting out of the forbearance, are ready to resume making payments. Many of those paid during the 90 days themselves, and some covered their escrows, as a matter of fact. So it is a very fluid environment in order to track the data. But I can promise you this, and I can promise those team members around me who ask the same questions, we're tracking it daily and trying to make informed decisions on mobilizing staff or strategy to meet those needs. So hopefully that provided a little feedback. Not great feedback in terms of specific data, but we are looking at the data points that will help drive our decision making for our customers.
Thank you, Brian. Thank you. Thank you, all the panelists. We are at the top of the hour. There are a couple other questions that we didn't get to. So what we will do is we will take those down. We'll probably reach out to subject matter experts to see if you can't share your wisdom on those, and then we will send them out to the group in writing. I did get a comment here from Julie Guggen at the Minnesota Homeownership Center, and I just want to relay this. I think it's very timely. She says, as a reminder that the Homeownership Center supports nonprofit mortgage advisors around the state available to all your consumers free of charge. We are there to share information about consumers' options, how to best prepare for conversations with you, and how to ensure long-term stability for their families. So thank you, Julie, for reminding us of that resource. Once again, Brian, James, Scott, Tony, fantastic job. Really appreciate your expertise and your time. For those of you on the call that are not members of the Minnesota Mortgage Association, I would encourage you to reach out to us and become involved with our organization. To the folks that are members, thank you for your support of the association. Next week, we have a training session put on by, I believe it's Genworth. And the week after that, on June 22nd, it looks like we're lining up a speaker from the MBA for another one of these leadership forums. So please get involved, please attend, and I will let everybody have the beautiful Thursday afternoon to themselves. Thank you, everyone.
Thank you, Roger.
Thank you.
Thank you.
Thank you, Roger.